Hello, welcome into the Multifamily Investor Playbook. I'm John Makarewicz, president at Ferris Capital Partners, and we're really excited today. We've got a bit of a different approach with today's podcast. We're actually going to be interviewing Dugan Kelley. Dugan is co-founder of Kelley Clark Professional Corporation. They're our U.S. securities law firm. They support us in all of our closings. Just an exceptional group. They do focus at this firm on securities and real estate practice. Dugan has over 2 decades of experience and more than $2 billion in structured transaction. Dugan helps sponsors, operators, investors navigate every phase of a deal, from the PPMs, JV agreements, loan docs, 1031 exchanges, really anything real estate transaction related. And his mission is simple: keep deals alive and help clients grow portfolios, not headaches. And Dugan, you've done an incredible job doing that for us, right? I mean, we were kind of talking right before we jumped on the podcast. You just, always expect the unexpected when it comes to these big real estate deals, right? Yeah, let's start with some kind of
Okay.
foundational questions, right? In your mind, what's the role of the securities attorney in a real estate syndication? And why is it so critical for operators to get this part right?
Yeah. Thanks, John. Thanks for having me on. Hello, everybody. Glad to be here. Um, yeah, the securities attorney is often kind of one of those unsung people in the background that you don't really think about, but they're a vital team player to your acquisition of your next asset. So, just as a fundamental level, remember, any time that you're raising capital and your buyer who's giving you money is receiving basically a share of a company, whether that company is a limited liability company, a limited partnership, or a corporation. That is the sale of a security, and it really requires scrutiny by a lawyer who's well versed in securities laws so that you cannot run afoul of that. There's an entire organization based out of Washington, D.C., that's called the Securities and Exchange Commission. And each state in the United States where you live as a potential investor, there's also a state securities board or a local securities commission that looks over offerings or those sales that take place in each of those states. And so it's kind of an intricate, vast network of regulations and individuals that are there both to promote the sponsorship of new capital into the economy, because that's what spurs job growth, and that's why we're all doing what we're doing, right? To spur job growth and increase kind of liquidity and net worth for all of those that invest with us, but also to protect investors. So that's one of the biggest things that the SEC and the local state commissions and their boards focus in on, and that's why you kind of need to have an attorney on your team that helps you navigate those waters as you're doing a private offering, regardless of what you're buying. It doesn't matter if it's in the CRE, commercial real estate space, or if it's in commodities, or if it's in pre-IPO tech, or if you're buying a donut shop. It doesn't really matter. It's most important that you understand that there are regulations, laws, rules, and there's fines and other things that could potentially be attached to those things if you don't follow the regulatory framework.
No, that's right. I mean, Ferris Capital Partners, when we talk about this, right, we're saying effectively what we're doing is we're buying a business. That's really simply put what we're doing. We're buying this business, which happens to be an apartment building, and effectively trying to improve the operations, just like, a private equity firm buying a business, right? And having gone through that process and worked with attorneys there, from an investor's perspective, you said something there like, a big part of your role is really protecting the investor, right? So
Right.
how do you see your, the securities attorney in that kind of investor protection? Like, what are some things that, from an investor perspective, you're doing to help look out for their interests?
Yeah, so first and foremost, we always want to remind the investors that they have the right to seek independent counsel, both from a legal and a tax perspective. Two, what they receive either in the email, or those of us that are OGs, old school, and they get it through their mailbox, or they meet with you at the coffee shop to see exactly what is the opportunity that you're asking them to review and potentially invest into. That should include a complete list of the potential risks and the risk disclosures that are attached to that potential investment opportunity. So if there's only just the opportunity and the investor has no idea about the potential risks, that's not a good opportunity. because there's always risks associated with investing. There are no guarantees in investing. And so ensuring that each of your potential investors, whether or not they become an actual investor, but that they understand not just the sizzle of the deal, but that they also understand the risks associated with that, so that they are knowledgeable and informed so they can make an informed decision about whether to invest. So that's the first thing that we always look at when we're talking to investors or we're preparing materials that a potential investor might see.
That's right. Having closed such a vast amount of transactions, right? I'm sure you've seen the good, the bad, and the ugly. What are some things operators do from your perspective that help minimize those risks? To your point, there's no way to eliminate risk, right? But what
Right.
are some things you see really good operators do to help minimize maybe some of those risk profiles that could come up in a transaction, such as maybe what we do at Ferris Capital Partners?
It's a great question, John. So for those of you that are listening, some of you may be investing for decades. Some of you are just thinking about investing, and some of you just may have just invested in your very first deal. The reality is the pressure points that sponsors, operators, syndicators, and I use those terms interchangeably, have are the same regardless of the time frame. So when I started practicing, it was in the late 90s, the tech bust, right? The bubble burst in 2000. So we went through a market cycle. And so you started to see some similar complaints that were being raised by investors. And then 2008, everything changed in 2008. And now we're in a little market cycle right now. And the
Yeah,
same conflicts, the same complaints, the same sorts of pressure points exist. And I would say the first and foremost is clear communication. You
yeah,
cannot over communicate with your potential investor. If you continue to communicate so much that the investor says, hey, time out, I'm out, or whatever, they'll just silence your updates. But one of the biggest pitfalls that I see younger, less seasoned operators in is either having hope without clearly communicating where the status of the deal is presently, right? And it's okay to tell your investor, hey, we're not meeting our pro forma, or our pro forma has changed because of market factors, right? The most obvious market factors in the last few years from a CRE perspective were the rapid rise in interest rates. Interest rates fluctuate. They have
that's right.
always fluctuated. They will continue to fluctuate. But the rise, meaning 11 times they rose in just such a short period of time, starting in March of 2022, that put tremendous pressure on every single loan that was a floating rate bridge loan in the CRE space. I don't care if you had the most pristine asset or it was the ugliest asset, those loans were under significant distress. So the inability or the refusal or the just didn't think about it of communication to investors about the objective market factors that were in the market at that time or that still persist in this time, whether it be insurance, the floating rate debt space with interest rate caps and the associated premiums associated with that. The over communication or the lack of communication is the number one thing, John, that
Yeah,
I think
no,
sponsors
it's
see.
you nailed it, right? I mean, I've always my whole career I've been in the service industry in some form or fashion, residential real estate, and I don't view what we do today all that differently, right? We're serving clients at the end of the day, and I used to tell our agents and I tell our team here at Ferris Capital, no one ever gets in trouble for over communicating, right? And I think the second thing that really jumped out to me is like hope, right? Hope is not a strategy. So it's one thing to sort of say, hey, we've hit this wall here or we have this challenge, and here's what we're planning to do about it, but not just putting on those rose tinted glasses, right, and just pretending like well, we'll just muscle through, right? I think what we've learned is that our investors actually really respond when we communicate challenges, even if they're small ones. For example, on one of our first deals, we missed that we were told in our inspection revealed that the irrigation system wasn't working, but once we took over the asset, we realized it was actually an issue that the well that the irrigation system was running off of had run dry, and we had to dig a new well. And so that was an unexpected expense, but we talked through it. Here's how we handled it. We were able to minimize some expense over here, and so it shouldn't have any long-term effect on the investment. But it's interesting. We get more positive feedback when we discuss those challenges sometimes because they just feel like, hey, you're not hiding anything, right? At the end of the day, and savvy investors know nothing ever goes fully to plan, right?
Right.
I always think about Mike Tyson's famous quote, like everybody has a plan until they get punched in the face, right? And sometimes the
Right.
plan has to change. So, no, that's great insight. And I think, from going back to that investor, that passive investor, these legal documents, right? They can be a little intimidating. They're
Yes.
not like a 3 or 4 page document. In some cases they might be 100+ pages. So, what are some things a passive investor should really be locking into in those legal documents before, say, wiring their funds into a deal?
Yeah, that's a great question, John. So remember, regardless of how the investment documents are prepared, meaning what's the wrapper, what's the stylistic way in which they're presented, they all should have the same ingredients that are baked into them. So if you're not seeing these ingredients or an ingredient inside of the private placement opportunity or the memorandum, then I would say that's a potential red flag. It may be not a deal killer for you, but certainly as an investor, you need to know what is it that you're buying, right? So this is kind of the sizzle, like that's what these are often what's discussed on webinars or in pitch decks or things like that. It's the flashy, glossy business side of the deal. It's what we all get excited for. It's why I invest. It's why John invests. It's why we get
Yeah.
up out of the bed. But number two, what are the risks associated with that investment, right? Understanding that. Three, is it a suitable investment for me? Because based on your risk profile or your education or even your net worth or your liquidity, there are certain deals that might not qualify for you to invest. You might not be an accredited investor, so therefore some opportunities might not be suitable for you to invest. And then we also want to make sure that we know exactly what the operating agreement or the limited partnership agreement or the shareholder agreement, if you're buying a share of stock from a corporation, that's the legally binding agreement that obligates the sponsors on the one side to deliver the deal points to you. So what you thought you were buying and how you thought you were buying and what your rights and responsibilities are going to be after the asset has closed, meaning after the raising is done and now we have to operate this business. What is it that I, as an investor, can expect, right? When can I expect my distributions? Are these quarterly distributions? Are these monthly distributions? Is this raw land where I might not get any distributions until the building or whatever it is that's built and they start taking in existing cash flow associated with that? Are there times in which I might have to inject new capital if the deal struggles or they encounter some sort of obstacle or challenge that's in the deal? That is the most important document for you as an investor to read. I can't stress that enough. A lot of investors don't read these things. And
Right.
I tell them, when I'm not on the deal or the sponsor side and we're vetting a deal for an investor, I say, yes, I don't expect you to play lawyer. I will explain to you what the pinch points are, but I still encourage all of my clients and anyone listening to this to actually read the material that's been prepared, because it will often govern both the upside, the best part of it, but also the potential, what happens in times of uncertainty, what happens in times of adversity, what times
Yeah.
in times of challenges. So those are the things that I want you to understand. And those are the same ingredients that are baked into every opportunity. So again, whether you're investing into a multi-billion-dollar hedge fund or an annuity or a CRE product, a commercial real estate opportunity for a multifamily building, those ingredients are need to be present so that you kind of understand what it is.
Yeah, no, absolutely. This may be a Warren Buffett thing, but it's something Mark and I talk a lot about, right? It's the 3 questions every investor should ask, like, what's the upside? What's the downside? And can I live with the downside, right? So,
Right.
as you know, a lot of our investors are actually on the Canadian side of the border. So, we have a Canadian securities attorney who we'll have on the podcast for our listeners at some point in the near future. But up there, it's interesting because they actually, there's just more regulation. I'll just put it that way up there. And so they actually look at things like concentration, like how much can one investor invest with one firm, right? And
Right.
so that's a factor. They look at obviously the accreditation, very similar to the US. But there's even additional layers, right? And it's almost like they're forcing a certain amount of diversification, which, as you and I both know, when it comes to investing, it's all about diversification, right?
Right.
I would never tell an investor to put all your money in real estate, right? I would never tell an investor to put all their money in the stock market, right? It's about having a balanced portfolio. And I know you're a believer in commercial real estate, right? As a piece of that diversification. So, really analyzing that right. What is the upside? What is the downside? And one of the things we touched on kind of earlier on is the floating rate. And at Ferris Capital Partners, one of the things Mark and I talked about early on is that if the deal doesn't work with fixed rate debt, we won't do it. When I look back, on sort of 2018, 19, 20, as the market was really, ramping up, I mean, we saw incredible transaction volume. I mean, in
Right.
some cases, double, maybe what was sort of normal in terms of, multifamily transactions. It was always intriguing to me. Now, I wasn't in the business at that time, so maybe I have that, benefit of 2020 hindsight, right, so to speak, even though I wasn't in these deals. But it was always intriguing to me that people were taking floating rate when you could actually get fixed rate. That was very attractive. So,
Right.
I'm not trying to ask you to get into the head of these operators, but why would somebody take a floating rate option when you could get a 3%, or 3.5% interest rate? What was some of the thinking there? And, now that you're maybe talking to some operators that are struggling with that, are you seeing maybe a shift in thinking going forward on how operators will approach debt going forward?
Oh, totally. But like hindsight is always 2020, right? So I
Yeah.
can tell you just from speaking to, I mean, when we see hundreds of deals each and every year. So based upon our sample size, and that's from acquisitions of assets from East Coast to West Coast. So it doesn't matter if you're investing in the Sun Belt, if you're investing in the West, if you're investing in the Northeast, wherever your hunting grounds were, there was a plethora, right? A veritable buffet of floating rate debt products that were being pushed out into the market from bridge lenders. When I say a bridge lender, that just means short-term loans by existing financial institutions. It doesn't have to be high risk, but these are short-term financial products by banks and other lending institutions to get you to that permanent financing, that Freddie Mac, that Fannie Mae loan. And even in the agency side, we saw floating rate. So
Yeah.
floating rate was not like this dirty word that people were doing deals in a back alley with sacks of money. That's not
Right.
what was happening. The mentality at the time from most operators, syndicators, or sponsors was that the floating rate loans gave them a better shot to get higher proceeds, meaning
Mm.
they were able to roll in some of the um, loan proceeds to actually implement their business plan, their CapEx. They were able to get higher proceeds for capital expenditures as well as the principal balance of the loan, whereas fixed rate loans weren't doing that. So therefore the sponsors would have to go out and raise that money, that extra money, through private investors. And so from the sponsors' mentality, there was a quickness, kind of like a let's go, let's go, let's go, to acquire deals. And the irony is, right now, in a high rate environment where we're seeing lack of deal flow, right? Because people are afraid about essentially investing in opportunities at a higher rate. But in a low rate environment, we saw there people were investing, they were just throwing money, and
Yeah.
basically anything from 2010 to 2022 was closing. And when the Fed was basically loaning out money at a 0% rate to these bridge lenders, and you just saw this massive amount of investment, it makes you kind of scratch your head and think to yourself, shouldn't you be buying more at a higher rate because you're able to play rate arbitrage? Because I don't
Mm.
know many economists right now or experts in CRE, certainly not us, that are projecting that the Fed is going to increase rates, right? Now, certainly he has not agreed, and the Board of Governors just came out of their last meeting. They did not agree to lower rates like many of us wanted. But even if they had lowered rates by 25 bips, unless they went in reverse history and lowered rates so substantially in such a short period of time, 11 times, it's not going to impact or change the trajectory or the need for all of those loans, thousands and thousands of loans across the United States, to be modified, restructured or those assets traded because the basis at which those loans acquired, meaning the price for the asset that was loaned upon, just doesn't make any sense anymore in many of those cases. And so I think the mindset back then, John, like
Yeah.
you were very astute, that the mindset back then was one of speed and availability, right? And that investors were literally shoving cash into
Yeah.
deals, believing that the kind of the merry-go-round on rent growth and projected earnings was never going to stop. And it came to a brutal stop when the Fed raised interest rates as fast as he did. And he isn't hiding this fact. Okay, so I don't want people to think that this is some sort of malicious villain out there that is intending to cause harm. And their fight, in their honest fight to curb inflation, they publicly have stated there are going to be some victims associated with this fight to curb inflation, and CRE is one of those victims, and it is one of those victims. And so
Yeah.
we have seen a number of deals by hardworking, good, honest people, from my perspective, that have lost deals or had to restructure deals, or investors have lost money during this last cycle. But that was kind of the mentality of like, the cash is it's too good to pass up. The terms associated with this bridge loan are too too good. And from 2010 to 2022, there was not a lot of volatility in the market. It was just like a rocket ship. So basically, anybody that wanted, then investors were exiting and making, twice their money, 40 or 50% on their money. So people that were investing in the stock market, accepting a 4 to 5% yield, what?
Yeah.
You're getting
Yeah.
100% yield, 40% yield, a 50% yield. You can see that kind of motivation, that lack of maybe foresight of like, this merry-go-round can't continue the same way. The rent growth can't continue to grow 100% year over year. Like, it just can't.
Yeah.
It's not physically possible. That just wasn't present. So that's kind of the hindsight aspect of what happened.
Yeah, it's like, the party will end at some time, right? And
Yes.
so just being prepared for that. And, it's interesting looking back on my career, just from a timing perspective, never obviously planning this, but when I got into residential real estate out of college, it was like 2001. And so, we were still dealing with a little bit of the reverberation of the 2000s, but rates dropped and we saw, just this incredible run up. And then, it was really interesting because looking back, you can really feel it in '06, the time on market, and this was speaking residential, of course, but it was just all of a sudden our days on the market started growing. And then I think Home Bank went out of business in early '07, and it was like, countrywide, and then, we kind of think about '08, but it was already happening. And, over a 20-year career in residential real estate, and having had an exit with the company that I helped build and create, Mark Spain Real Estate, when I look back on our biggest growth, periods, it was actually in those more challenging times, right? The
Yeah.
'08 recession. I mean, '08 kind of sucked, but by
Yeah.
'09 we kind of figured it out. And so, at Ferris Capital Partners, on one hand, we have friends in this industry that are in pain right now. And so we're not like sort of celebrating that, but we're also saying on our side, being a newer firm, we can learn from some of these lessons and also, candidly take advantage of maybe some of these deals that are now on sale, right?
Right.
Because of maybe the way they were purchased originally. And so that goes back to, creating these golden rules, that fixed rate debt,
Right.
strong reserves, right? Only buying deals that cash flow on day one. And those are the three that we live by. And so what that means is we have to look at 300 deals to find one that,
Right.
will get under contract right now. I know that ratio will improve as deal flow increases, but, kind of prior to starting the recording, you were sharing, you're on the road a lot and,
Yeah.
part of your role, right? Like, you're not necessarily the guy processing the paperwork, right? Like you're the high level guy at the firm. And so you're talking with lenders, you're talking with operators strategically, in some cases, maybe helping them
Right.
navigate, this changing climate. So, what are you seeing from that side? Like, I'm reading articles, for example, I saw one just last week that there's like $36 billion in commercial real estate, multifamily deals that have already been extended, right? And, the analysis was good because it did say in most cases, the interest is being paid, the loans are being paid, but at what point do the lenders say we have to make a decision here, right? We can't just keep extending and extending and extending. So you had shared a few insights. I'd love to get your kind of color on what you're hearing in the marketplace right now and what you expect maybe in the next 6 to 12 months.
Yeah, thanks, John. It is a, I would say it's frothy. It's very frothy out there in
Yeah,
the CRE space. So what does that mean? That means that we're kind of not in what I would call a broker-led capital markets, meaning the traditional way in which many sponsors, operators, syndicators have acquired deals in the last decade or so, right? Is develop a relationship with a commercial real estate broker, look at potential market opportunities that are marketing, submit your letter of intent, hope that you win that beauty contest, get that thing under contract, get your debt lined up, and then raise your capital and then essentially acquire the asset. A lot of what's going on in the place in the capital markets right now is not that. What is
yeah,
happening is really trying to assist either bridge lenders. And remember, a bridge lender or a lender of any sort is your biggest investor.
that's
Sponsors,
right.
operators, syndicators, they have the most amount of skin in the game. And for many of these loans, these were non-recourse loans or qualified non-recourse loans. So their exposure to market factors, those objective market factors, they are going to take massive losses associated with that. So trying to create creative solutions to assist those lenders and the existing sponsor groups with being able to facilitate the trading of those assets and the recalibration and resetting of the basis, meaning the price for that asset, is super important in this economic environment. It's not unlike what we were doing in 2008. This is
Yeah,
not 2008. I don't want anybody to think this is 2008. This is like in 2008, we had a cash problem. Where's the money, right? Where
right,
is the
right.
money? We don't have that problem now. In 2025, there's plenty of cash. There are trillions of dollars sitting on the sidelines right now being ready to be deployed by family offices, institutional investors, and also retail investors, mom and pops. The question is, where is the deal flow? So like John said, there is a significant amount of time right now because of the increased basis, because of the volatility in the capital markets, underwriting deals and figuring out how you can pull or modify some of the levers to essentially allow an asset to trade. And so it's a very challenging time. So we spend a significant amount of our time trying to encourage lenders to think about taking floating rate debt for assets that are currently on their own balance sheet to move to fixed rate,
Mm,
right? So move it from a floating rate to a fixed rate. Maybe lower the rate theoretically, right? So what was functioning at acquisition at like a 3% rate, and it floated now to like in a 9.5 or a 10.5. Obviously, that's not going to hunt. But will the property cash flow at a 7% or a 6.5%, and the yield that the lender is still going to get is still going to be ample to meet their expectations for like an exit, a successful exit. So trying to understand both from a lender's perspective as well as a borrower, operator, sponsor perspective, we spend a significant amount of time doing that. That means that you basically have to get your suitcase and travel, and you have to spend a lot of time in New York and where the lending institutions are, to understand both from a credit committee as well as investment committee, as well as kind of like the boards of directors for many of these financial institutions. They're not in it to hurt the borrowers. They didn't get in this game to sue the key principals or the guarantors. They will.
right.
In some cases, they have the legal right to theoretically do that if there's been a breach of their loan covenants. But they are there primarily to ensure that their stakeholders, their shareholders, the people that have invested in those banks, receive essentially what was represented as the investment that they were making in that. So it's a giant wheel that we're all on. And regardless of where you enter into that wheel, whether this is your first deal or whether you represent lenders or you are a lender, us as a firm that helps facilitate the trading of essentially assets, the papering of that, and the disclosure of associated risks associated with that, it's super important that we understand the lender's mentality, because I think for many sponsors, operators, and syndicators, if you haven't been as aggressive as you should have been with your existing portfolio, whether that means whether you're willing to accept something less than probably what you want from an exit perspective, and rip the band-aid off and tell your investors that they're potentially going to see a loss of the investment, to negotiating with your existing lender to see if you can modify or restructure your existing loan, to theoretically informing your investors that maybe there's not able to do it because the lender, for whatever reason, is not willing to modify the existing loan. Maybe they've securitized their loan. Maybe they don't even have rights to do anything what you're asking for. All of those things are super, super important. That's why we spend a significant amount of time, at least 6 months of the year. I'm on the road talking to lenders, meeting with clients face to face, trying to help mitigate essentially risks or whatever. I
Mm,
travel less. I travel less when the market's great, right? When deal
mhm.
flow is amazing and there's not a much of problems. But when there's problems, it really requires creative kind of solutions and creating open dialogue between you and the lender. These things magically aren't going to fix themselves.
Right.
You have to, with massive exertion and work, try to fix it, and understanding how it can be fixed. That's the key to the key to anything. But that's the key certainly to kind of fixing what the environment is that we're presently in, or that many sponsors find themselves inside of their deals.
Yeah. And, kind of in a sense, shifting gears, but along the same lines, recently the big, beautiful bill passed, right? And, a lot of controversy surrounding that, right? We're not getting into, the nitty gritty of the whole bill here, but, one thing and some things that really stood out is that there was a lot of things that were very favorable for commercial real estate in that big beautiful bill. And I'd mentioned to you, Dugan, as we mentioned it earlier, a lot of our investors are Canadian, so that quote unquote revenge tax was taken out, right? So that was
Yeah.
something we were watching very closely. Trump has a very aggressive negotiating style, to say the least, and so there was you probably know the story, but there was a digital services tax that was meant to go online July 1st, and they pulled back on that, which allowed the Senate and the House to pull out that revenge tax. So we were very thankful for that. But we do have U.S. investors, so I know a lot of this is really geared towards that U.S. investor. But maybe talk through what you saw in that bill and how you see it'll help CRE, just from a kind of a big picture, broad perspective.
Yeah, I love that. So I have a lot of family that are Canadian,
Yeah.
Canadian by birth, because we were born and raised in Montana,
Yeah.
right by Alberta. So
Okay.
like we still have family members that invest, and they're the difference obviously is the debt, right? This whole industry kind of moves on debt. And
Yeah.
the way tax incentives, the U.S. economy is brilliant in the way that that has been crafted and created. So one of the biggest things that my investor clients that were thinking about, hey, what are we going to see, right? Because we were seeing over the last few years the sunsetting on the depreciation side of things. The fact that they were able to reset, so now an acquisition, a new asset that was placed into service in January of 2025 to all the way to 2032, you're going to be able to take advantage of bonus depreciation and to accelerate that depreciation. For many people, the time for them to make decisions on investing is in the third and fourth quarters of each and every year. Why?
Hmm.
Why is it the third and fourth quarter? Because at that point, they start to know what is the amount of money that theoretically I have made this year
Right.
in order to put your tax planning into position, right? So many people that base their investment decisions, Canadian and American alike, all across the essentially the world, and what they're looking for is an effective tax planning investment opportunity. You can say whatever you want about the volatility in the commercial real estate, but if you look a snapshot of the last like 20, 30, 40 years of investing, if you had invested in the S&P 500, the Russell 2K index, or in the private investment space dealing with CRE, the CRE private investment space, from a return, both a cash flow and appreciation return, far, far and away outpaced the S&P and the Russell 2K index. It's not even close. But from
Right.
a tax efficiency perspective, being able to actually hold on to some of that hard-earned money that you actually earn. There's nothing better, in my opinion, than investing in commercial real estate. And so that big, beautiful bill, the biggest thing that got passed that most investors that invest into commercial real estate is the fact that bonus depreciation is
Mm.
back. It's back. It's back in a big way. And so when John and their team roll out an opportunity for you to invest, and it is a multifamily opportunity or something like that, you know that they're going to be able to take advantage and be able to pass significant tax benefits to you in and whenever you're essentially planning to invest. And so that's one of the biggest takeaways. It was something that is not it's not just for the Republicans and it's not just for the Democrats. I like to say this is completely agnostic. It doesn't matter. It's apolitical. Investing doesn't have to be political. You don't have to say I like this administration or I like this administration. It doesn't matter. We are
That's right.
completely agnostic to it. This is you investing green. If you want to grow wealth for you and for your family and to take advantage of legal tax components that are in the system, you need to seriously think about investing into CRE. And that is one of the biggest takeaways from the passage of the big, beautiful bill out of Washington, D.C.
Yeah, no, I love it. And one thing I always say is that like politicians come and go, but the fundamentals of investing don't change often. Right now, in this point, maybe they become more attractive, right, because of bonus depreciation. But when we look at, for example, you can go to the Fed website, and this analysis is actually related to single family rentals, but the only time single family rental asking prices have dropped was during the Great Depression. And then I think it was like in the 80s they started tracking apartments a little more closely, and it's only flattened out like in '08, right? In other
Right.
words, rents rise, and they typically rise right alongside inflation, right? And then obviously other factors like demand, supply in the market, economic, population growth can help even juice those returns a little bit. So, thinking about like an investor, right? Like for us, like we're always looking at areas that, once again, high population growth. We like economic diversity. So there's not just like one or two industries providing the bulk of the jobs in the area, right? So a lot of different industries. So, nothing's recession resistant, right? But can you at least, help be a little more resistant, or I should say recession proof, but a little more recession resistant would be the right way to say it. So, for example, the Sun Belt, the Midwest areas that are seeing that population growth. Affordability is, of course, another factor. And of course, one
Right.
thing we look at, and for me, having spent so much my career in residential real estate, we're simply just not building enough houses. And I don't see anybody trying to fix it. And I don't see any way to fix it at the end of the day, right? Materials costs have risen. You have regulatory costs at the local level. For example, where I live in Alpharetta, Georgia, they're very thoughtful, and I like the way they manage the city, but they can mandate what kind of building materials you use, what the exteriors look like, and all these things add costs, not to mention land costs rising. So, I'm foreseeing a world in which the US will become more and more a nation of renters.
Right.
And gosh, look at the National Association of Realtors. A few years ago, the average first-time home buyer was 28. Within the past 2 years, that's become 38. The average home buyer is 56 years old, right? Now that
Right.
might be their second or third home. So, I've got a 21-year-old, and I'm sitting here going, well, I guess I'm going to have to be saving up some money, to help him with his down payment on that first home if he will ever afford a home, right? And so, there are some things that it's scary for me, as somebody, I love this country, right? But it will provide opportunity, right? And that's where CRE comes in. So, kind of wrapping up, what else should a passive investor, or an investor be thinking about, like, before considering investing in a project such like we do?
This is such a good relationship system, John, from the standpoint of people invest with people that they like, know, and trust, right? So these have been hallmarks of investing. It doesn't matter if you've been investing for a lifetime like Warren Buffett, or you're just waking up, you got your first job and
Yeah.
you're slinging coffee through a drive-through. That's what my son does right now. This is his very first job. And I'm trying to encourage him. I'm like, think about starting to invest, right? So remember, people invest with who they like, know, and trust. And so part of that is when you're looking at an investment, What questions, if this is a new relationship, what questions have you asked the sponsors? Do you really know the sponsors? Have you vetted the sponsors? Have you read all of the material? Have you asked questions of them? Have you gone to their references or talked to the references? So you know, it getting into the investment game is super easy. Losing money can often be super easy too if you don't follow some of those golden rules.
Yeah.
Finding an existing team that you have a high level of confidence and trust in is super important and key for any investor. And the reality is, I tell people this, what's the biggest impediment to people's overall success? And I say it's fear. Fear is a huge driver. But if you think about fear, fear is not a good decision matrix. You should not be making decisions either on to invest or either not to invest on the basis of fear. So fear is the primary matrix within which you view this. I want you to change your thinking, and don't sit there and think, oh my gosh, I'm full of fear and I must be the only one that's out there that is full of fear. No, everyone struggles with fear. Every single person. It's not a US thing. It's not a Canadian thing. It's not a UK thing. It's not
Yeah.
a Europe thing. Everyone struggles with fear. But being able to understand that fear, push through that fear, and get in the game. Because if you don't invest, you're never going to win, meaning you're
Yeah.
never going to achieve any amount of success. You may lose some amount of money. That's that. I don't want to say it's okay, because people say losing money is never okay, but it's a practical consequence of investing in anything. You will at some point lose some amount of money, but if you are consistent and you have a good team behind you, and you like your sponsorship team, I encourage people, it's time to invest. It's really time to invest. So get and push through that fear.
No, you're so right, and I think what really stood out to me is the team component, right? Like who are the people at that company that you're investing with, and meet those people, right? Get to know them. Like, what is the resume, the pedigree of the team? And I think in business in general, it's always about the team. Nobody does this stuff alone, right? And I know at Mark Spain Real Estate, when we got really clear on hiring the right people, and not just filling the seat, right, but getting the right person in the right seat, our results just through the roof. And so it's why we love working with Kelley Clark. Candidly, I mean, your team is exceptional. Everybody we touch over there is fantastic, quick to respond, quick to provide unique and creative solutions to challenges or problems we may encounter. And so we just really love working with you. So if you're an operator listening to this, and maybe you're not happy with your current firm, or you're just looking to explore, definitely reach out to Dugan over at Kelley Clark. We'll put his contact information down there in the show notes so you can touch base. But we have just absolutely loved this relationship. In my experience, once again, in business, relationships are super critical. And when you find a great vendor and you can really lock arms, you can do a lot of great things together. And you guys are always there to, watch our backs, make sure we're not making any mistakes, and, more importantly, protecting our investors, right? So,
Thanks, John.
yeah, it comes from the heart, man. It's just been exceptional. Not all vendors are created equal, right? And so it's just been a pleasure. So thank you so much for your time today, Dugan. Your insights have been absolutely incredible, and it's even given me some new things to ponder, kind of as we think about our approach going forward, and how we help our investors navigate the documents and things like that. It is a funny thing. I mean, how many people just don't sign, read agreements before signing. So I think that's a huge takeaway for our investors. Take that time to go through it, understand the risk profile, and we're always here to answer any questions you might have. But once again, thank you so much, Dugan. This has been great. Really appreciate your time. If you like what you've heard and you're interested in learning more about Ferris Capital Partners, go to fulloutinvesting.com. We have a sample deal deck on there just so you can get a little bit more knowledge about how these deals are structured. We also have a video that walks you through our 10-step process, from finding, building broker relationships, finding acquisitions, all the way to exit. And there's also an opportunity, if you'd like to book a call with Mark or myself, just to talk about your investment goals and learn more. Thank you so much for tuning in to the Multifamily Investor Playbook. We love and believe in you. If you've liked this content, please like and subscribe and share with other high net worth individuals. Have a wonderful day.